Okay, this video is an illustration of internal control over the purchasing and payables process. So let's first take a look at the view of purchasing and payables from an overview from the 10,000 foot levels, I call it. And what we're going to do is, in order to start the purchase payables process, we start off with a need to purchase something. In this case, we're going to basically requisition either goods or services. Now, in our case, we're going to simplify this by saying that we're requisitioning the purchase of inventory for resale in the future. So right now, we're going to requisition goods for inventory. Next, then, based upon that requisition, the purchasing department, which is a company that makes professional acquisitions, the best goods and the best goods or services at the best possible prices and terms, are going to go out and purchase goods and services. The goods then are going to be shipped to us, the customer, and through that fulfillment process, we're going to receive those goods or services I say here, but we're just assuming they're goods. Also, then we're going to update our inventory records to reflect the receipt of those goods. And then we're going to approve the items for payment, and then we send a cash disbursement, typically or traditionally in the form of a check, or it could be electronic funds or a wire type of transfer. So that's a 10,000 foot view of the purchases and payables process. Let's go on now and take a look at how this process works in detail. Again, I will mention to you that this is a illustrative flow chart. There's many different ways that the purchases and payables process could be depicted. This is simply one of them. It doesn't mean it's the right one. It is one way of doing it. Okay, so the first thing is, in order to initiate the purchases and payables process, we have to have a need for a good or service. In this case, we have a need for, we're going to go for inventory. So the individual who's in charge of ordering inventory is going to prepare a purchase requisition for the inventory. The requisition is going to be approved typically by some manager. In other words, it's not going to be approved by the requestor themselves. It's going to be approved by somebody who has been given the authority to approve that within the company's delegation of authority. So the purchase requisition is created. The purchase requisition then is sent to the purchasing department, and the purchasing department will obtain price quotes, bids, and so forth from approved vendors with the goal to acquire the goods or the inventory at the most advantageous prices and terms. And again, the purchasing department will be separate from those people who are approving and requisitioning the goods. The purchasing department then, after it meets a meeting of the minds with the vendor, it will issue then a purchase order, which in effect is the company's legal contract to purchase the goods or services, and again, goods in this case. Now, when the purchase order is issued, there's at least 3 copies that are issued. One goes to the vendor as acknowledgement of the purchase. Another copy of the purchase order goes from the purchasing department to accounts payable, and another copy of the purchase order, which we call a receiving report, although it's really a copy of the purchase order, goes to the receiving department. It's also very important to note is that purchase orders are pre-numbered, or in some other way they're controlled to ensure each document, each purchase order, can be accounted for. So we can identify each purchase order so we know if any purchase order is missing or out of place for whatever reason. So now let's go on after the purchase department's issued the purchase order. Okay, what's going to happen is that the receiving department is going to receive a copy of the purchase order, and we talked about that from the previous slide, and that's depicted there. So now the receiving department has a copy of the purchase order or purchase order / receiving report on file. So that means that the receiving department knows to expect these particular goods from this particular type of vendor. At the same time, the vendor fulfills the order by sending the physical goods to the company's receiving department. And the items that are received then will be verified that the goods were actually purchased. In other words, the receiving department will not accept anything that is not part of a receiving document. They're going to say we didn't purchase this. This was not acquired through a purchase order. So if they don't have a receiving document, they will not accept the order. Now, when they do match the order against the receiving document, they will then verify the type and the quantities of that good or that inventory received. In other words, they'll say if we're supposed to receive 15 pieces of product XYZ, they'll verify that's exactly the items that were received on their copy of the purchase order. After the receiving department receives those items, they will forward a copy of the receiving report to the accounts payable department and another copy to inventory control. So we can see here the receiving report. Oh, the other thing I also want to mention is, again, receiving will only accept those goods listed on the receiving copy of the purchase orders I talked about before. Receiving verifies the receipt of the goods, and then receiving will also reconcile all the purchase order receiving documents, again, which are pre-numbered, to ensure all have been accounted for and processed. So the only items that go through, the only documents that go through receiving are authentic documents, and no document is going to be missing. Okay, now the receiving report goes on to, as I mentioned, accounts payable and inventory control. And at this point then, inventory control is going to update the perpetual inventory records, which says we've received 15 pieces of product XYZ, and the perpetual inventory records are updated. Also, because the receiving reports are pre-numbered controlled documents, inventory control reconciles all purchase order receiving documents to ensure all have been accounted for and have been processed. Okay, now we're going to go on to see what happens with that receiving report as it goes on to accounts payable. Okay, now what we see is the copy of the receiving report, which I've depicted. Whoops, I had to get my pen working again. The receiving report, which goes into the accounts payable department. Now, at the same time the receiving report is being received within the accounts payable department, we're also going to be, the accounts payable department is also receiving a copy of the purchase order from the purchasing department. So that's on file there also. Also, then, the accounts payable department is going to receive a copy of the invoice from the vendor looking for payment. Now, what will happen then is accounts payable then will match the purchase order to the receiving report and to the vendor invoice. So before we are going to make a disbursement, we're going to, number one, match with the fact that we actually purchased the items through the purchase order. We also receive the items through the receiving report, and we've been invoiced for the items. And again, we match that against our purchase order for the correct pricing and terms. So upon matching those three documents, accounts payable then will process that invoice for payment to the vendor. And as I say here, as accounts payable reconciles a vendor invoice to the purchase order generated by the purchasing department and the receiving department receiving report generated by the receiving department. That's where I'm mentioning again that three-way match between the vendor invoice, the purchase order, and the receiving report. Now, with the matching of these three documents, and that word is misspelled, but that should be with the matching of these documents, accounts payable creates a voucher packet that includes the proper accounting distribution. In other words, the type of accounts that the type of general ledger accounts the amount in question should go to. Also, they also include the copy of the vendor invoice that was received. They also include a copy of the purchase order authorizing the purchase and a copy of the receiving report showing, giving evidence that the items were actually received. Then accounts payable will enter the voucher itself, that voucher packet, into the accounts payable system purchases journal. So it would be recorded as an accounts payable purchase. The voucher packet then will be sent on to the proper approval authority so that the invoice can be processed for payments. So now we see the accounts payable voucher packet, and the accounts payable voucher packets are also pre-numbered. In other words, every voucher packet is uniquely identified and can be accounted for. What we're going to see is then, as part of the entering the voucher into the accounts payable journal, we're going to see a debit to the appropriate account that we decided it should go to and a credit to accounts payable for the general ledger. Also, we're going to post our payable to the accounts payable subsidiary ledger. Okay, now let's go on to the where the voucher packet goes after this then. So the voucher packet itself, which has now been basically been matched, the purchase order, the invoice, and the receiver have been matched, then it goes to an approval authority, typically again a manager who has some level of authority, who's going to review that voucher packet and ensure that the three documents do match together. If those three documents match and there's no problem, the individual then will approve the voucher packet for payment. The Treasury, and in this case, Treasury reconciles the pre-numbered approved vouchers to ensure all and only authorized transactions have been processed. So now the Treasury Cash Disbursement Clerk or the Treasury Department receives the voucher packet that's been approved and reviews the documents for completeness and clerical accuracies, a check. For each disbursement then, based upon the approved voucher packet, the clerk prepares a check and records the check number, the dollar amount, the voucher number, and other pertinent data in the cash disbursements journal. And we can see here the check is prepared, and I'm going to talk about a canceled voucher packet here in a second. And we also make the journal entry, a debit to accounts payable for the payment of the liability and a credit to cash. And as I mentioned here, the voucher packet and accompanying documentation is canceled. And that's what this represents here, the canceled voucher packet. Now, the reason we cancel the voucher packet, and what that means is that I cancel the packet itself and I cancel the items that are contained within the packet. Again, that it includes the invoice, that includes the invoice from the vendor, the receiving report, and also the purchase order. And the reason I do those cancellations is that those items cannot be pulled out of that voucher packet and somehow reintroduced back into the accounts payable process for another payment. So once I cancel the voucher packet, all of the documents within the voucher packet are also canceled. Now the check signer then, who signs the checks, up to this time the checks have been prepared but they haven't been signed. The check signer reviews the voucher packet and its supporting documentation to ensure that it properly supports the cash disbursements and the voucher packet's been canceled. If that's the case, then the check signer signs a check and it mails. The check signer then causes the check to be mailed to the vendor. The canceled voucher packet then goes to accounts payable, where we remove the amount of payables from the accounts payable subsidiary ledger. Now, if we take a look at we've kind of looked at the document flow and some of the key controls within the document flow. What we can look at also are the individual controls that I've listed out in all the other internal control presentations in terms of what we need to do in order to ensure that internal controls work within this case, the purchases and payables process. In this case, we're talking about segregation of duties, and it says here the functions of individuals should be adequately separated to ensure that each function within the payables purchases payables process performs an independent check on the accuracy and authenticity of the other functions within the processing process, so to speak. And this would include approval of transactions, the issuance of the purchase order, the approval of vendors who we're going to buy things from, the receiving function and the creation of the receiving reports, the accounts payable function, including the matching of the invoice, the receiver, the purchase order, and update of the purchases journal. Also, another function that's separated will be updating the accounts payable subsidiary ledger, then approval of accounts, or approval of the accounts voucher for payment, the check preparation, the check signing, the distribution or the mailing of the checks, and then this says recondition, but this should be recognition of accounts payable unpaid reconciliation of accounts payable unpaid vouchers with the accounts payable subsidiary ledger, and also reconciliation of the accounts payable subledger with the accounts payable control account. Now again, other major control points under the purchase payables process. Okay, purchases are initiated based upon approved purchase requisitions. Purchases should be routed through the purchasing department through approved vendors. In other words, people shouldn't be able to select their own vendors. People should rely upon the purchasing department to purchase the right products from the right vendors at the right prices. Okay, also receiving is the only authorized department to accept the merchandise noted on their copy of the purchase order form. In other words, receiving is in charge of all the receiving all goods. It's a best practice to use what we call blind receivers. Now, this is not necessarily a requirement, but you probably want to know what a blind receiver means. And a blind receiver is a copy. Remember, when we're saying when the receiving department gets a copy of their copy of the purchase order, which we also call the receiving report. However, the problem with that is it is a copy, meaning that they will see the exact items they've ordered and the exact quantities of the items. A blind receiver normally blocks out the quantities of the items, which forces the receiving department to count those items instead of simply saying, yeah, that looks like 25 items as it says on the purchase order. So a best practice is these use blind receivers. Again, some companies use that, some do not, but you just need to know what that meant. And again, I mentioned it here. These are copies of the purchase order receiver that do not include quantities, so the receiving personnel will be forced to count delivery rather than relying upon the printed information on the purchase order receiver. Okay, the next item, then the third item, is accounts payable vouchers and related journal entries are prepared only when accounts payable confirms goods are received through the receiver, the purchases of goods have been authorized through the purchase order, and the vendor's invoice is correct by checking the vendor's invoice, in effect the matching of the documents. Okay, next then is accounts payable vouchers are entered into the purchases journal, and that's debit whatever expense or inventory account, credit accounts payable, only after they have been approved for payment and only through the accounts payable department. The check signers ultimately ascertain that the proper support exists for the voucher and then they check before signing the check for that. Multiple signatures may be required for checks larger than a preset limit. In other words, in some cases, a single signatory will review the voucher packet and sign the check as an authorized check signer. In other cases, if a check is over a certain amount, the check may be required to be signed by two check signers in order for that check to actually be negotiable. And in that case, the second check signer would also give a second look at the voucher packet and then also insert their signature. So that would require two signers instead of one. Now, check signers, if they use instead if they may not physically sign a check, they may have a mechanical device called a check signing machine or a stamp which represents their signature. Now, if that's the case, those check signers should keep their signature plate for the check signing machine under their control at all times. And the same thing if they have a signature stamp that works for their check signing, or that is utilized for check signing, they should keep that signature stamp under their control at all times. Okay, now also some other items that we may need to consider regarding payables. Access to unused check stock. In other words, check stock that has not been used yet. That's limited. Not everybody should have access to that. It should be limited to authorized individuals, and those particular individuals should have no roles in the cash disbursement or bank reconciliation process. So they should have no roles in the cash disbursement bank reconciliation process. Again, that's a requirement under proper segregation of duties. As I mentioned before, in our document flow, accounts payable vouchers and all supporting documents are canceled upon payment to prevent their use as support for potential duplicate disbursements. Okay, vouchers that have been approved for payment but they haven't yet been paid should be periodically reconciled to the accounts payable control account. But when you think about that, the only items that should appear in the accounts payable control account are the vouchers that have been approved but have not yet been paid. The accounts payable subledger accounts also should be the accounts payable subledger accounts, which represent the individual invoices that the company has approved for payment but not yet paid, are reconciled then to that accounts payable control account. Okay, all bank accounts, lines of credit, debit and credit, and negotiable instruments are to be maintained under general ledger control, meaning that if we have a bank account or if we have a line of credit, we should have a general ledger account open to account for those particular transactions. Okay, and those accounts under general ledger control, the detail of the account should be reconciled and have appropriate review and approval on a monthly basis. That's reconciling our checking accounts, our lines of credit, debit and credit type of accounts to our general ledger control accounts. Okay, all cash bank accounts per the general ledger must be reconciled back to the respective bank statements periodically, and the recompilations, or sorry, and the reconciliations, not recompilations, the reconciliations reviewed by a manager not involved in the cash disbursement process. Okay, so with that, let's go ahead and take a look at question number 1. And question number 1 says, which of the following describes a weakness in internal control over accounts payable? You're given 4 descriptions. Go ahead, stop your video. When you're ready with the answer, go ahead and restart your video. Okay, number 1, which of the following describes a weakness in internal control over accounts payable? And the answer in this case is A, the accounts payable manager issues purchase orders. And again, this is a problem with segregation of duties. The accounts payable provides the recording function. Therefore, accounts payable should not be involved in an authorization or custody or custody to cash or other assets. So the answer in this case is A. Let's go on to try number 2. Number 2, to ensure effective internal control, the accounts payable function should, and again we're given 4 possibilities. Stop the video when you've made your choice. Go ahead and restart your video. Okay, and the answer to number 2, if you didn't see me flip through that accidentally, was B. To ensure effective internal control, the accounts payable function should ensure the agreement between the purchase order, vendor invoice, and receiver. And we also call that in under internal control, we also call that a three-way match. That's a match between the purchase order, the invoice, and the receiver. So that would be the proper answer. Okay, let's go on and try question number 3. Number 3, the authority to accept incoming goods should be evidence on A. So it's looking for some form of documents for the evidence of the authority to accept incoming goods. So again, stop your video when you're ready with your answer. Go ahead and restart the video and review the answer slide. Okay, number 3, the authority to accept incoming goods should be evidenced on basically the purchase order, if you will, a copy of the purchase order. Remember that a copy of the purchase order is forwarded to the receiving department as notification to receive the shipment. Okay, let's try question number 4. Number 4, to provide assurance that vouchers or their supporting documentation could not be resubmitted for payment. We have 4 different options. Go ahead, review the options, stop your video, and when you have arrived at an answer, go ahead and restart your video. Okay, the answer to number 4. To provide assurance that vouchers or their supporting documents could not be resubmitted for payment. And the answer in this case is D. Vouchers and supporting documentation should be, in this case it says marked as paid. That's the same thing as being canceled. In some way they are all marked with a specific marking that indicates that they have been already used. Okay, let's try question number 5. Number 5, for well-designed internal controls, individuals in the purchasing department would, so for well-designed internal controls, individuals in the purchasing department would, so go ahead and stop the video, make what you have determined is the appropriate selection, and restart the video again and look at your answer, or review the answer slide. Okay, number 5, for well-designed internal controls, individuals in the purchasing department would be in the position to negotiate prices and terms with the vendors. That is they're going to select the vendor and they're negotiating the prices and terms with the vendors. So let's go on and take a look now at number 6. Which of the following actions may indicate that internal controls utilized in the previous year may not be adequate in the current year? So this is a little bit, it's not that much harder, but it requires a little bit more thinking. So which of the following actions may indicate that in controls utilized in the previous year may not be adequate in the current year? So again, take a look at the 4 options, stop the video, and when you are ready with your answer, restart the video to review the answer slide. Okay, and let's take a look at the answer to question number 6. Which of the following actions may indicate that internal controls utilized in the previous year may not be adequate in the current year? So we take a look at each one of these, and the answer would be B. The CFO waived approvals on accounts payable payments to expedite payments to vendors. And what we're really saying is that the internal control regarding the accounts payable matching function is being overridden by the CFO. So that means that internal control was not actually functioning. Now, if we take a look at these, it's probably a good idea just to review these other answers, since this question tends to be a little bit more, the questions tend to be probably a little bit more ambiguous and cut and dried. The first one is the members of the audit committee of the client's board of directors are all new members. Now, typically this is not wouldn't be a control issue unless for some reason the new audit committee was not fulfilling its duties. In other words, we can't assume that the new committee, just because they're a new committee, means they're doing things wrong unless we're told that. Okay, if we take a look at C, C says the company modified check signing requirements from 2 signatories to 1 signatory. Now, what that means is instead of 2 people looking at the check, now only 1 person was going to be looking at the check. The point is we still have an authorized individual looking at basically reviewing the voucher packets and signing the check. And as it says here, while 2 signatures may be preferable in some situation, 1 signature is still probably pretty much likely adequate. Okay, then we go on to D. The receiving department is now responsible for quality control inspection as part of the receiving process. And actually, this kind of sounds a little weird, but it's becoming quite a common thing. And matter of fact, it's actually preferable. Yeah, and as a matter of fact, they say down here, becoming a common function as part of receiving, and it really enhances control because in some cases, when we receive something, we don't really know if that item is functioning. If it's, if it basically is functioning up to the specs it's supposed to, or is it broken? And this is really true when we get into the electronics industry because you can count out 100 integrated circuits or 100 different boards or whatever, but you don't really know if they're working unless they're sent through some type of quality control. Now, in some cases, what will happen is, as I mentioned here, it'll be received in receiving, but the receiver is actually never submitted to accounts payable until quality control within the receiving department performs the quality control check, because the one thing you don't want to do is pay for defective merchandise. So with that, that is the end of the presentation for internal control over the purchases and payables process. Thank you so much for your time.